A very good evening, participants. Welcome to Open House on enhancement of dynamic price bands for scripts in the derivative segments. If you recall, for those of you who had joined last month, also on 18th of October, we had done similar open house session because at that time, as per SEBI guidelines, the implementation date was on 21st of October. Then, as an update, on 18th October itself, we had issued circulars informing all of you and the market participants that it is extended. The implementation is extended till further notice. And if you have referred the circulars which we have mentioned in the invite, we have subsequently issued the circulars on 8th of November, which is recently couple of days back, which mentions all the implementation guidelines for which today I have the concerned department personnel from NSC with me. So I am Jwalin Gandhi, and with me I have my colleagues from surveillance, Mr. Benoy and Mr. Bereshwar, who will take you all through today's session on explaining various nuances of the topic. Now, let me just request you throughout the session, in case you are having any queries, I request you to put your questions in the questions box. And at end of the session, during the dedicated window, we'll take the questions one by one. So over to you, Bereshwar, first, just to give the briefing summary about the implementation that is about to happen.
Right. If you all have referred November 8th circular, which we have issued both in cash market and F&O, this is quite an important circular that was issued because this involves, as we discussed in the last seminar also, this involves cancellation of orders beyond the band, and there are certain restrictions on the range of options in the cooling period. So those are the main two topics. So we will detail it out in our PPT, which Binoy will brief, and in between, wherever necessary, I'll also pitch in. So please be very attentive in this particular session because it has an impact on the orders that you punch in those particular securities where the volatility is actually high. And therefore, one needs to keep a tab on the orders that are pending and that are in the system and that are outside those bands. So if all these three parameters are met, those orders will be cancelled. And whenever you wish to further execute those orders, you have to punch in again instead of assuming that the orders were already there, because till now the orders were not being cancelled. So that's the big change that is coming up. And the mock date is November 16th, and it will go live from November 18th. So this is again, as you can recollect from the previous seminars, that this is regarding the strengthening volatility risk management and minimizing information for extreme price movement, the sliding band on account of flexing, and your trading in option segment during the cooling off period of the underlying as well as the futures contract. So Bina will take over, and one by one we will see each and every component in detail. And please keep on the questions, logging in the questions in the dialog box, and one by one we'll take it up after the finishing of the PPT. So Bina. Yes.
Thanks, Bereshwar. So I'll share the. So this is the SEBI circular. So we'll take it one by one. So in our previous webinar, we had covered the first 3 points, that is point A, B, and C of the circular. So just to give a recap of the points A, B, and C. So in point A, it was about enhancing conditions precedent before flexing of price band. So here in the change which was already implemented on 27 May 24. So here the conditions of flexing, the number of trades have been increased to 50 and the UCCs have been increased to 10, and the condition of 3 unique trading members have been introduced. So that is the change which is already live. Point number B is about aligning price bands between underlying and the futures contract. So here what was happening is when the near month is getting flexed, the underlying as well as all the other contracts will concurrently get flexed. And similarly, if the underlying is getting flexed, all the other contracts, that is near month, middle month, and far month, will get flexed. That is also been live on May 24th, 30th this month. The circular is of 30th May. And point number C is about strengthening of volatility and risk management and minimizing information asymmetry. So here we are, there is a telescopic flexing wherein the cool off period is increasing with the number of flexes. So that is the first two flex. The cool off is 15 minutes and the percentage of flexing is 5%. And in the subsequent third and fourth flex, the percentage will decrease to 3% from 5%, and the cool off period will increase to 30 minutes. And in the fifth and sixth flex, the cool off period will increase to 60 minutes, and the percentage of flexing will reduce to 2%. So now coming to the topic of this webinar, that is point number D and point number E. So this, as Bireshwar mentioned, we will be having a mock session on November 16th, that is this Saturday, and it will be live from Monday, that is November 18th. So here there are two aspects. One is the sliding price band on account of flexing, and point number E is the trading in options during this cool off when in the underlying market.
So we have issued this circular on November 8th, covering exactly this information. So hope you have had a look at it. So we have referred the numbers also. So Binoy, we can repeat the numbers of the circular once.
Yes. So the circular number is 6. So if you see the bottom of the screen, the circular number is for FNO it is 64995, and for cash segment it is 64994, which was issued on 8th of November last week.
So all the details that are there in PPT is there in the circular also.
Right. So now coming to the first point, that is sliding price band. So here what is the condition which is going to be introduced is whenever, so when the price band is getting flexed on the direction in the price movement, obviously the conditions of trades will be checked. That is the 50 trades, 10 UCCs and 3 trading members. So so now currently what we are having is the expanding price band. So that is, if the price band is say in the example for this upward flex scenario, if you see this table, if the base price is say 100 and the price band at start of day is 10%, and so the band will be 90 to 110 to begin with. So if the flex conditions are met, say at 110, then the price band will be 115. And in the current scenario, it is an expanding price band. That is, as per existing framework in this table, the price band will be 90 to 115. That is, the upward price band will be flex, and there will be no change in the downward price band. But now in this release, as per the SEBI circular, the price band will be sliding. So that is the amount of increase which we are on the upper side. If we are increasing by 5 in this example, the lower band will also be reduced by 5. So that means it will be a sliding price band. So now in this scenario, the new price band will be 95 to 150. And another important feature is about the cancellations of orders. So any orders which are pending, so if you see the last line, the pending orders with limit prices which are not within the new price band would be cancelled by the exchange. So that means any orders which in this upward flex scenario which are lying between 90 to 95 shall be outside the new price band. So those will be cancelled by the exchange, and there will be an appropriate intimation on the trading workstation. So that is on the need terminal or the CDCL terminals, you would be getting the appropriate message for this order cancellation. And so similar is the case for downward flex scenario. So again, if we take an example, the base price is 100, the price band is 10%, and the lower band is 90 to 110. So if the lower conditions of the flex are met, so the in current scenario it will be flex from 90 to 85, and the upper band will remain same at 110. But post this release from November 18, there will be a sliding band. So here the new band will be 85 to 105. So both the 5% increment will be done on both the sides, on the lower as well as the upper side. And so I hope this example is clear. And so now coming to stop loss orders. So stop loss orders, as many of the members would be knowing, it is a separate book. So the stop loss orders won't be cancelled by the exchange. It will remain in the stop loss order book, and only on trigger. So if when the limit price is getting the trigger price is getting hit, it will check the limit price and it will check whether it is within this range or not. So if it is within the range as per the extend mechanism, when the stop loss order is getting triggered, the limit price, if it is within the price band, it will be accepted by the exchange. So there is no change in this existing mechanism of handling stop loss orders. So now this is the details of the message which I referred when on order cancellation, which will be displayed on the trading workstation. So for need users, the message will be displayed as an order prices outside the revised price range for all the order cancellations done by the exchange, which is outside the range. And the sliding band, the message will be revised price range for the instrument, and symbol and expiry details will be provided. Is minimum price to maximum price. So this will be the message on need for the sliding band, and as well as the message for order cancellation. So similar for NNF users, the error code of 16020 for order cancellations, order prices outside the revised range, and the transcode for the new price band will be as per 7305. So these details we have mentioned in the circular as well. So now coming to an illustration of the sliding price band, but this is a separate scenario wherein of exceptional scenarios of highly volatile price movement. So now we have seen in certain cases, like there could be a scenario wherein the price is say moving up, the upward price band is say hit at 110. So if you see in this example, and within the cool off, suddenly there is some news or some global news, the price is again going down on the opposite direction. So now what will happen? So if the exchange will cancel the orders and the price is already moving on the opposite direction, then it will be it won't be correct. So hence there is this mechanism of midpoint flexing. So now here, in case, as we see, in case of exceptional scenarios of highly volatile price movement in the opposite direction within the cool off, the impending flex will be cancelled if such price movement is breaching the midpoint of the price band. So and the important thing is, at this midpoint also we will check at the conditions of the flexing, that is the 50 trades, 10 UCC and 3 trading members. So if I take an example, so similar example, if the base price is say 100 and the price band is 10%, so the initial lower band and upper band will be 90 to 110. And if the upward price band flexing conditions have been met, the new band will be 115 to 95. So 95 to 115 will be the new price band. So now suppose in this 15-minute window, so suppose we are assuming there is a first flex, so this will be a 15-minute cool off. So if within this 15-minute cool off, the midpoint of the price band, so that is 90 to 110 divided by 2. So if the midpoint, that will be 100. So if the midpoint is breached, So 100 or below, the price, the LTP is meeting 100 or below, and the conditions of flexing, that is the 10 UCCs, 3 trading members, and 50 trades are being met, then this flexing, which was going to be affected after 15 minutes, it will be cancelled by the exchange. So I repeat, it will be cancelled by the exchange, and there will be no flexing in effect. So now again, we have given certain illustrations here below. So the price band will remain at 90 to 110. Even at, in this example, say 215 was the timing when the flex was to be affected. So this flex at 215 will be aborted if the midpoint of 100 is met. So now similarly, if you see downward, when the current price band is say 90 to 110, and the impending revised band is 85 to 105. So at the end of 15-minute period, if the impending band was 85 to 105, and if the LTP is greater than equal to 100, because it is lower flex, we will look at LTP greater than equal to 100, because we are looking on the opposite side movement. So in the upward, it will be LTP lower and less than equal to 100. And for downward, we will look greater than equal to 100, because we are always looking at the opposite side. So again, in this case, if within this 15-minute window, if the midpoint is hit, then the impending flex, which was going to be affected at the end of pull-up, will not be done by the exchange, and it will remain at the original price band. And obviously, if the price band is going further down, and if the downward flex is getting triggered, then the flex will be done on the in the sentimental direction. So yeah, so that was about the midpoint part, and these are all not so frequent scenarios, but the exchange has built in this mechanism so that there won't be unnecessary order cancellations by the exchange. So now coming to the second point about trading an option segment during the cool off in underlying. So as per this SEBI circular, so when the underlying is under cool off, so obvious, if the underlying is, there is no movement in the underlying, so ideally there shouldn't be much movement in the options, which is linked to the underlying. So during the cool off, there will be a temporary ceiling on the LPP, that is the limit price protection limits. So currently, as everyone knows, there is a limit price protection, which is 40% of the simple average price or the theoretical price on a, and it is keeps on updating at every 30 seconds. So during the cool off, when the underlying is hit flex, there will be a temporary ceiling. So this 40% will be, there will be a reduction in this 40%. So so if the LTP of the stock options contract is available, then the temporary or floor or the ceiling will be linked to the LTP of the stock options contract. If it is not available, then it will be linked to the theoretical price of the options contract. So and the LTP in the, so if the LTP is not available, that is if the LTP is stale, in that case we will refer to the theoretical price. So what is the definition of stale LTP? So in the current LPP mechanism, if we are not using the simple average price, that is the simple average price is the traded prices average of the last 30 seconds. If for LPP we are not using the simple average price, in all other scenarios we will be using the theoretical price. So that is the definition of stale LTP. The details of LPP we have mentioned in the circular 61814. And so now what will be this temporary floor and ceiling parameters? So there will be an absolute rupee movement which is allowed, which is similar to the LPP parameters, and there will be a percentage movement which will be allowed above the LTP or the theoretical price. So I have a slide on the parameters in the further slide, so I'll come to that. Then so on the other side, so wherever the flex is getting triggered, only the ceiling and floor will be applied on only on the sentimental side, and on the other side, that so for example, if the upward flex is there, the ceiling will be only on the upward side, and the downward side it will be as per the current LPP mechanism. And the that's what we have mentioned. Applicability of ceiling and floor is only on the sentimental direction of the price trend in the underlying. So if the flex is on the upward side, the downward side will still remain at 40%, and the upward side there will be a temporary ceiling and floor. And once the price band is flexed, so assuming a 15-minute cool off, it will revert back to the original LPP mechanism of 40%. And as other conditions which are similar to the LPP mechanism, that is during the LPP mechanism, the buy order is greater than high LPP is rejected. So any incoming order placed beyond the LPP range shall be automatically rejected by the exchange as below. So any buy order which is greater than the high LPP shall be rejected, and sell orders will be allowed. Similarly, if the sell orders are below the low LPP limit, those will be rejected by the exchange. However, buy orders with limit price beyond the low LPP shall be allowed. And if there is any passive order which is already sitting, those matching will take place, even though it is outside the ceiling or the floor. And as I explained in the earlier slide, the stop loss mechanism also remains the same. Whenever the stop loss orders are getting triggered, it will check for this temporary ceiling and floor of the LPP. And all other conditions of the LPP shall remain as per the current logic, which we have already explained in 61814. So now coming to the temporary ceiling and floor parameters. So similar to the LPP mechanism, so in LPP we have the threshold. So for contracts which have price greater than 50, we have a 40% threshold for the normal LPP. But when the underlying is under cool off, the temporary ceiling will be set at 15%. So the 40% will be reduced to 50%. And for contracts which have less than equal to 50 rupees, the absolute price movement allowed will be 7.5 instead of 10, which is there in the existing LPP mechanism, which is not in cool off.
So therefore, during the cooling off period, basically the larger band, the band in the direction of the movement in option segment, we are reducing that down band. So because there is no movement in the underlying, so there has to be a very limited movement we are envisaging in during the cooling off period to actually limit the speculation. That is the objective. So therefore, the upper band, if the price is moving up, the upper band is reduced to 15%. In case it is moving downside, the lower band will be reduced to 15%, and the other like 7.5 rupees in case of the lower where the band itself is below 50. So that way we are trying to reduce the band so that in the direction of the movement, the speculation is reduced.
Right. So now this second table is showing us the applicability of ceiling and floor in the sentimental direction. So as I said, if it's a upward flex, the ceiling will be applicable only on the high LPP, and the low LPP there will be no restriction. So the low LPP in this case will function as per the existing LPP norms of 40% or 10% absolute value. And similarly, so if it's an upward flex, for call there will be a ceiling on the high, and for put there will be a floor on the low LPP limit. So since if the prices are moving up, obviously the put prices will go down. Hence, there is a floor for put prices and ceiling for the call prices. And vice versa, if it's a downward flex, the call prices are supposed to go down. So there will be a floor for LPP low limit for call and there will be a ceiling for the put high LPP. And on the other side, there will be no restriction. It will function as per the existing LPP mechanism of 40% F and 10 rupees absolute parameters. So now this is a detailed example which will explain to you so that there is utmost clarity on this movement of the options. So now if we take an example, say at 9:70 before the cooling off period, the reference price was 100. So this reference price can be the simple average price or theoretical, whatever is the case as per the LPP circular. So as I said, the LPP parameters is 40% and 10 absolute. So in this case, before cool off, the LPP high and low was 140 based on the simple average price of 100, and low was 60 for call. And for put, so assuming it is say same 140 and low 60.
So basically 40% from the reference price.
Okay. So suppose there is a trigger of flex in the underlying market at say 9:17 and 01 seconds. So now since that LPP cooling off is so the underlying is cool off period is started, the temporary ceiling and floor will start kicking in. So now in the same example, so now the important thing to remember is at the start of cool off, we will look at the LTP at the start of cool off. So in this example, the LTP at the start of cool off was 100. So that's what we have explained in this notes of dollar here. So assuming the LTP at start of cool off is 100. So if we apply 15% to this LTP of 100, the ceiling will be 150. So orders, so the orders beyond 115 will not be allowed. So buy orders will not be allowed if it is a upward this thing, as we explained in that template in the previous slide. Buy greater than high LPP limit will not be allowed.
And so just to clarify, this 100 reference price, in case the LTP is not available, it will be the theoretical price. So just to clarify that.
Right. And so as we discussed, there will be no restriction on the low LPP. So the low LPP is being calculated at 40% of 100. So and similarly for put option, if the LTP is 100, the LPP high. So since we are looking on the sentimental direction, since it's an upward flex for put, it is assumed the price will go down. So there will be no restriction on the high LPP. The restriction, there will be a ceiling, there will be a floor restriction. So it will be allowed up to 85 rather than the earlier low LPP of 60. So this will be the first stage at start of cool off. And now, so during the cool off, now we are assuming the prices are moving up and down. So in this example, say at 9:18 and 30 seconds, suppose the price is moved up from 100 to 110. So as the mechanism, since it is a ceiling and floor, there will be no change in the high LPP. So it will remain at 150, although the price has moved from 100 to 110. And same is the case for the low LPP for put options. So although the price has moved from 100 to 80 in the put example, the floor will not change. It will remain at 85. So that's what we have given in the circular as well. So we have said ki assuming the price is 100, irrespective of the change in LTP from 100 to 110, and similarly change in LTP from 100 to 80 for put option, the capping remains at 85 of put and 115 for the call option. So now coming to the second scenario. So say assuming at 9:18 the So on the other side, so as we said, this will be only on the sentimental direction. So if the price is, it will also look for the ceiling will be only in the sentimental direction, and the current mechanism dynamic revision will be applicable on based on the reference price of the LPP as per point E, which we have already mentioned. So now here the price of the low LPP will be at 66 itself. So so in this low LPP, so since the price has moved at 110, it will look for whether whichever is more conservative. So if it is say 40% is more conservative than the temporary ceiling, it will restrict at the 40%. So in this example, at 925, the price has changed to 80 rupees. So now 40% of 80 is 32. So that becomes 112. And the temporary ceiling which was decided is 115. So the system will look at whichever is conservative of 112 and 115. So since 112 is conservative, it will apply the shift the ceiling from 115 to 112. So
So it will move the band to 112. Ceiling will still be 115 because again it is when it is increasing from 80 to 100, it is again restricting at 115. So at no point in time it will move beyond 115.
right. So it will so since 112 is more conservative, it will allow up to 112. Then so same is the case for in this put scenario. So here again the price has moved from 80 to 160. So here again the although the floor was 85, the 40% of 160 if we calculate, it will allow up to 96. So since 96 is more conservative, the orders will be allowed up to 96 rather than 85. And on the higher side, as we said, there will be no restriction. So it can, so suppose the price is moving, say, gradually up. Uh, so in this case, say the price is moving gradually up, it can go up to, say, in this case, it can go up to 224 also. So on the other side, there is no restriction. The existing LPP mechanism will be applicable. So hence, this price is moving up to 224, and in this example, the low LPP is allowing up to 66. So that's what we have explained. The applicability of ceiling and floor is only on the sentimental direction. The current mechanism of dynamic LPP revision will be applicable. So this is, we have another example of downward.
So just afterwards, at the end, we have mentioned that as soon as the cooling period ends, 9:30 to 01, again you will go back to the original bands.
So this is another. So all this we are this example is assuming there is a 15-minute cool off. So obviously the cool off, as we discussed earlier, the cool off, it can increase based on the number of flexes. So that is another important point. So this mechanism is applicable during the cool off window. So it can vary from 15 minute to 30 minute to 60 minute, depending on upon the number of the count of the flexes. So as we said, first two flexes is 15 minutes, and third and fourth will be 30 minutes, and fifth and sixth will be 1 hour cool off. So this entire mechanism will be applicable during the cool off period. So again, just to revise with the downward example. So in this example, same, if say at 917 the price was 100, the LPP ranges will be at 140, 160 for call, and put also similar ranges. And suppose the downward flex is getting triggered at 917.01. Since it is a downward movement, for call, there will be a floor of 85, and on the high side, there will be no change. And for put, since it is downward movement, there will be a ceiling at the higher end,
and low side there will be no change, it will be 40%. And similarly, if the price is say moving from 100 to 80, so 100 to 80, the ceiling remains unchanged at 85 and the high remains unchanged at 115. And the other example of the extreme movement, so if there is an extreme movement of say from 80 to 180, as we discussed, the conservative limit shall apply. So 180, if we apply 40% on 180, it will be 108, which is much more conservative for the low side of LPP. So it rather than allowing up to 85, it will allow up to only 108 because the movement there is a movement in the reference price. So as we discussed, the current mechanism LPP would be applicable based on the prevailing simple average price, subject to the temporary ceiling of high LPP of 115 for the put and low LPP of 85 for call option. So that's what it will conservative. It will check and it will be subject to the ceiling. So if it is exceeding 85, it will restrict at 85. However, if it is conservative, it will restrict at 108. And in the for put example, it is 112. So 80 ka 40%, it will be 112. And since 112 is more conservative than 115, in case of drastic movement, it will restrict at 112, this example, rather than 115. And after the 15-minute cool off, it will revert back to the existing LPP mechanism. So at 9:30 to 01 second, since the cool off period is over, it will again revert to the normal limits of 40%. So again, so now if you see in this example, from the low LPP of 85, it has come back to 60, and for the high LPP of 115, it has come back to 140. So I guess we are clear with this example, and I think we are done with the presentations. Now we can take the questions.
Thanks, Binoy. Thanks for the detailed explanation that you have given for the functionality. Just to reiterate, participants, as we have been mentioning on the slide also, the functionality will be available for mock testing on coming Saturday, that is 16th of November, and the functionality will be implemented in live from coming Monday, which will be 18th of November. And as we have in starting mentioned the circular numbers which are recently issued on 8th of November, there are two circulars, 64994 and 64995. Now, going ahead with the questions that many of the participants have already put in, let's quickly go to the questions part, and probably Bireshwar and Binoy can chip in to answer them. Germany is asking, how are the upper and lower limits of the price band determined?
So I think this is
You can go to that slide.
yes. So if you see in this example, so at the initial stage, there is a dynamic price band for stocks which are part of the future segment. So the initial band is 10%. So if we assume a base price of 100, the price band will be 10 percentage. So the lower and upper band will be 90. So 100 minus 10, that is 90, and 100 plus 10, that is 110. And so now in this revised framework, which is live from November 18th, there will be a sliding price band. So the price band will slide on both the sides. So if the conditions at flexing at 110 are met, that is a 3 trading members, 50 trades and 10 UCCs, then the band will be shifted from 110 on the upper side to 150, and from 90 to 95 on the lower side. So there will be a sliding price band.
Okay, so Germany, we hope that it is clear. Next is Mr. Nimesh Parmar from Surat is asking, his question is not that clear, but I'll try to interpret correctly if possible. So he's asking if you are not allowing the range which you explained, probably where you probably said that the orders will automatically get cancelled by the exchange. Then he's asking why DPR is opening up, which is a wide range probably. He's saying that any client can put in the order if DPR is there, and then automatically, as per the criteria functionality that is being implemented, it may be cancelled. So he's just asking then why the DPR is being opened.
No, so as we discussed, the original DPR at the start of the day in this example is 90 to 110. But when the flexing is happening, the DPR itself is shifting. So I mean below 9 now in this example, below 95, the DPR itself is now shifted from 95 to 150. So that's the reason why exchange is cancelling the orders as per the SEBI mandate, the SEBI circular. All orders which are outside this 90 outside the price band, that is in this example between 90 to 95, shall be cancelled by the exchange as per the SEBI mandate. So hence the DPR itself is now shifting from the old 90 to 110 to 95 to 100.
Okay. Next, again, couple of people have been asking, even though we have explained in detail, if you briefly want to touch upon again, people are asking what is the new dynamic price range? I mean, probably they want to understand the meaning of dynamic price range. So quickly, if you can just reiterate.
Yeah, so dynamic price range is like all stocks which are part of futures and option segment. There is no fixed price band, right? For equity segment, we have a fixed price band, but for stocks which are part of futures and option, there is a dynamic price band. As in, so if the initial band is 10%, if the price band, if the trades are happening at, for example, at 9.90, and the conditions of flex, that is the 50 trades, 10 different UCCs, and 3 trading member on each side of the trade are met, then the price band is flex. So that is the meaning of dynamic price band. So same conditions will be checked at the revised higher range of 115. So if again this condition met at 115, again it will be flexed to 120. So that is the meaning of dynamic price band. That is, there is no fixed band. The band keeps it's dynamic in nature. It keeps on changing.
Okay. Mr. Raviraj is asking, could you please share the recording of this webinar? So, Mr. Raviraj and other participants, just to tell you again, all the open house webinars that we have been conducting in recent past, we have been uploading over NSC's YouTube channel. There is a playlist called Open House Webinars, wherein we upload all these sessions. This session will also be uploaded probably in a day or two, which will be available for you. But by that time, because other participants have also been asking about some material, so we have already mentioned the circulars which are issued on 8th of November, wherein all the key updates, the revised criteria, explanation, etc. is explained, which we have discussed during today's session also. So you may also refer the circulars, which will be handy to you. Now, next is,
so just to clarify on that earlier question. So if you see, the sliding price band is based on the underlying. So and the pull off is based on the underlying. So if there is a flex in the underlying, only then the related contracts will get there will be a sliding price band and the pull off. So index, there won't be any impact as such. It is based on the underlying movement.
Okay. So therefore, this entire circular will actually apply on index futures to the extent of sliding bands. However, index options will not be affected.
Okay. Now, next is question is from Mr. Sahil Roy from ICICI Security, who has been asking about the NNF error code which we showed over screen. So probably he's saying that in PPT there was something else, and NNF error code mentioned in the circular is 16521. So probably the reason, Mr. Sahil.
So the PPT is having the FNO wala message area. The respective circulars will have the respective messages. So you can.
Correct. So, Mr. Sahil, as there are two circulars, so one set of code is given in circular 64994, and another set of code is in 64995. So, respectively, you'll have to refer for the respective.
So the segment wise is given. So one is for the FNO segment where you have sliding band plus the option ceiling. The other is in the cash market where you only have the sliding band. So accordingly, please see the messages that will come out for cancellation of orders.
Correct. Mr. Sajid from Angel One is asking, will the changes for sliding price band and auto order cancellation be applicable for all segment, that is cash, future index, future stocks, option index, currency, commodity, etc.? Though we have answered, but for sake of clarity.
So let's understand. So sliding band is applicable for cash and futures, and the options ceiling part is only available for the cooling off period. So there is no sliding band for options as such as yet.
Okay. Here's also yes, Bilal.
And this so the cooling off will be based on the underlying movement. So there is no index angle over here. If there is a underlying is under cool off, only then this LPP temporary cooling off will be applicable for the stock options.
Okay, that is what he has asked next also, that LPP changes are applicable only for stock options. That is what he has asked.
Correct. So
okay.
Yeah, so only for the stock option. So in the example which we saw here, so these are all the prices of the underlying. So as we mentioned, even in the heading, if you see, if the option segment during cool off in the underlying contract, in the underlying as it. So if the underlying is under cool off, the option contracts of this stock will be under temporary cool off or temporary ceiling and floor.
Okay. Next is Mr. Naman Sharma from Manilicious, who is asking, pending order outside the revised band will be cancelled or rejected. He's asking for error code 16020, which we have shown. So whether it will be cancelled or rejected.
No, it will be cancelled because the orders are already inside the system, right? So when this example, when the original band was say at 90 to 110, the member would have placed the order. And after some time, because of the sliding price band and the flexing, the brand has now moved from 90 to 110 to 95 to 150. So hence now exchange all orders which are already lying between 90 to 95 will be cancelled by the exchange.
Okay. So because as you know, the orders get rejected if they are outside the operating price band, and then there is a LPP mechanism which further restricts the order to come in. In this case, however, once the orders are there in the system and the band is moving, the orders which are pending orders which are not there with the limit prices within the new price band gets cancelled. So that's the change, and this is a new thing that is happening. This has never been done earlier. So therefore, we are again and again requesting you to get your doubts cleared, refer to those circulars. November 8th circular is very important because it gives a complete understanding with examples as to how the orders will get cancelled. And therefore, please, whenever this video gets, this YouTube video will gets again floated in our YouTube channel, please review it again and do participate in the November 16th mock, so that further you can experiment with orders outside the band and see how it operationally works for you. So that's why this seminar is very important.
Correct. Next is Mr. Tushar from Fires. He's asking, is cancellation of order applicable in the cooling off period when range from 40% to 15% is coming? I guess he is referring to our example. So whether that cancellation is applicable during that cooling off period?
Right. So again, so for options, so again, I will like to reiterate that there is no cancellations for options contract. The orders cancellation is only in the underlying and the futures. Okay. So this temporary ceiling, which the point number E is about only temporary ceiling. So in options, there will be no cancellation of orders. Here we are just restricting the entry of orders beyond this prices. So if you see this slide, so meanwhile, so the sliding band, so the part D of the circular, that is sliding band. So cancellations will be only in the underlying cash market as well as the futures contracts. there is no cancellation for option contracts. Okay, so there is only that temporary floor and ceiling, and no orders in option contracts will be cancelled.
Okay, next question is related to a couple of other functionalities also. Mr. Kiran from Wickup Securities is asking how many chances of orders hitting original band during cooling time and cancelled by exchange, and will they be subject to OTR or PNC as well?
How many chances of orders
hitting original band during cooling time? So probably cooling off period he is mentioning.
Okay. So, yeah, the chance. I think the question is not that clear, but if I get you correctly, so during cooling off, so obviously up to that price band, the orders can come in, right? So now if the original band is say 90 to 110, till the cool off, obviously orders can come up to 110. So there is, there is no restriction in order entry. And obviously this, if it is orders are cancelled by the exchange, I think we will take that feedback and we will.
Yeah, so just to add to this, so when the ceiling or the floor is decided, because of the options cooling off period, beyond that ceiling and floor, options will the orders will get rejected. So now, so there is this ceiling works exactly as the LPP works. So when the LPP is restricted, beyond that you do not have the orders which are non-beneficial, in the sense that buy orders which are placed at very high prices would be rejected, and sell orders placed at very low prices will be rejected. So it exactly works according to the LPP principle.
Right. So any order which is, just to reiterate, any order which is having a buy order price greater than the high LPP. So this is already provided in our circular. It will be rejected by the exchange during this cool off period. And any sell order which is less than the low LPP limit will be rejected by the exchange, will not be allowed by the exchange. And however, on the other side, if it is a sell order, it will be allowed during this cool off, and vice versa. If it is a buy order beyond the temporary low LPP limit, that shall also be allowed.
Okay. Next is how the user will be come to know about the 15% range during cooling off period.
So, if you see in the example, we have already in the circular we have already mentioned the parameters of 15% and 7.5. So that remains constant,
and all the ranges are designated as well.
Yes, and LPP ranges, I think it is already, it goes via goes to the trading member. So that.
Okay, so that is what another member is asking, whether LPP changes during cool off period will be part of the broadcast or not.
Yes,
it will be part of the broadcast. Okay. Then Mr. Vinay from JP is asking how member will be notified regarding floor and ceiling of LPP during cooling off period.
Similar. So floor and ceiling is of the LPP, and because the LPP ranges are designated to the trading terminals, these ranges will also get designated.
Okay. Mr. Saurav from ICICI Securities is asking temporary LPP is only for the cooling off period, and once the cooling off period is over, then again the original LPP will be applicable?
Yes.
Right. Answer is yes. Okay. Okay, Mr. Pandurang, even though from Kotak Securities is asking the basic query, but what is the cooling off period, and does it mean trading stops? I mean, if you can just briefly reiterate.
So trading, as I said, trading doesn't stop during the cooling off period. It is only a temporary ceiling or floor. So for options, the orders will, it will look for the ceiling and floor, and orders will keep on flowing in. And even in the underlying market or the futures, the orders during the cooling off will come up to the existing band of the until the band is flexed, and trading will continue at the existing band of if it is the initial band of say 110.
Okay. Next, again, as just a while ago we mentioned, Mr. Himanshu is asking if we can send the PDF over email. So, Mr. Himanshu and other participants, the circulars are getting all the details which we repeatedly mentioned. So, please refer those circulars. There are illustrative examples as well,
Yes.
and the revised criteria also.
So all the details that were there in the PPT is there in the circular. So just refer to those two circulars which have been issued by surveillance on November 8th. Sorry, not by surveillance, it is issued by MSD on November 8th. And we can actually again refer to the invitation. If you can refer the invitation, the numbers are exactly given.
I'll repeat the number. The circular numbers are 64994 and 64995. Both of them were issued on 8th of November 2024, which is just a couple of days back only. Next question is from Mr. Kiran from Wickup again. Why we need cooling time for 15 minutes? If you want to address
Right.
it.
So the idea being cooling off is if there is heightened movement. So as per the SEBI circular SEBI press release of 2000 during COVID, SEBI had introduced the mechanism cooling off. The idea being so it gives the enough time for the market participants to to have a cool head. So if I take a literal meaning to cool down the senses and take a decision of placing orders.
Informed decision. So basically, just control your emotions for that 15-minute period. See what's going on in the market, and then decide to punch in your orders rather than actually. So if a selling starts and the price starts to go down dramatically, and this cooling off period is introduced so that all the participants are then can take a pause, control the emotions, see what's going on, listen to the news, reject the rumors, and then put their orders again instead of going with the flow. That's the entire genesis behind the 15 minutes cooling off period, which, as Benoy said, it started off in March 2020 via SEBI press release. And during this March 24, 2024 SEBI circular, there also now it is extended to like within the cooling off period, there are extra bands or cooling and sealing in the options is taken so that people further have a little bit kind of emotional control over trading in options as well, so that the option prices also don't go haywire. That's the purpose of this further cooling off period, sealing as well as floor restrictions in option contracts.
Okay, we have some more questions which we'll try to cover as many as possible. Mr. Aman from Zenskar Securities is asking how the OTR will be monitored.
OTR, as we said, the current mechanism will apply, and the cancellations of orders we will check and we will revert. We will try to take into account the exchange cancellation.
Okay. Next is Mr. Abhijit is asking is LPP range provided by. Then Mr. Aniket is asking, is there any way to see the LPP range applicable during cooling off period and display to client as a reference for order placement? So I guess similar question he's asking.
I think as of today also all your OPR ranges as well as LPP ranges get disseminated to you, and there is no change in that dissemination as of now. So whatever gets disseminated, the LPP and OPR ranges, the similar thing will happen with the new ranges also.
Okay. Then Mr. Balaji from Wealthin Broking is asking this dynamic price band whether we can test on 16th mock mock testing or not. It should be available for testing, right?
That's this mock session on November 16th is being held to thoroughly test the entire market should test that on the mock environment as to the applicability so that they can when it is live on November 18th, they can adjust their order placement patterns.
Okay. Mr. Aniket is asking, in case of a sliding price band is aborted, then existing placed orders which are within the original price band and slided price band will be cancelled or not?
Right. So,
The midpoint.
midpoint. Yes. So here, as I said, if the midpoint is hit, so in this example, 100 is the base price and midpoint is also 100. If the midpoint is hit and the conditions of flexing, that is a 50 trades, 3 trading members, and uh, 10 UCs are met, then the flexing which was going to happen at 10:15, say after the cool off of 15 minutes, that will not be affected. So it will be aborted, and obviously there will be no sliding band in this case, so it will remain at the original band of 90 to 110. And since there is no sliding band, there will be no order cancellations as well. So in fact, the reason why we have brought the midpoint mechanism is to avoid order cancellations if the price has moved in the opposite direction, and it does move significantly because it has now again from 110 it has come back to the from where it has started, that is 100. Hence there is no requirement of sliding the price band, and obviously accordingly we will not be canceling the orders, and since the band will not be sliding.
So just to give one more clarity of the earlier question, regarding the broadcast of LPP ranges. So we have a FAQ regarding LPP, which was released earlier, which specifically says that exchange broadcasts the applicable LPP range for the active as well as revised strikes through a separate LPP specific broadcast channel for the non-need front-end users. The range for each token is computed periodically throughout the day, and the same is broadcast by the exchange whenever there is a change in LPP. So you refer to that same. So we are not changing anything. You refer to the same channel through which you were receiving the LPP ranges. In that same channel, now after this ceiling and floor is decided, the LPP ceiling and floor prices will also get designated through the same channel.
Okay. We have 5 to 6 questions which have come up, which are probably the last 5 to 6 questions. Mr. Sahil is asking whether the orders will immediately get cancelled when the price is frozen, or will it take some time?
No, the orders will be cancelled only after the band has slided. So in this example, so suppose 2 o'clock the price band is hit in this slide, and the 2:15 the price band is yet to be flexed. So once the sliding of the band has been affected at 2:15, only at that point in time the orders will be cancelled.
And it will be immediately once that happens.
It will be.
Okay. Then probably again another participant.
And just to add, obviously, as we said, you will be getting the message on your trading system. That is the order price is outside the revised price range for need, and for NRF users, this is for FNO market. And as we discussed earlier, for cash market, there is a different error code and which is mentioned in the cash market circuit.
Okay. Even though we answered one question sometime back, a few more members are asking related to OTR and PNC consideration. I mean, whether such order cancellation will fall for OTR and PNC as well. Will that happen?
No, we will take into account these are exchange cancellations and not affected by the members. So.
Okay, then again, just in connection to earlier question, Mr. Pandurang is asking that whether cooling off period is only reference for point number E of the SEBI circular, and it doesn't have any relevance for point A to D. Is it correct?
Cooling off period is sorry.
So he's asking whether cooling off period is applicable only for point number E of the SEBI circular, and it doesn't have any relevance to point A to D.
Okay, A to D. So point number E is the temporary ceiling and the floor.
Yes.
Right, and the cooling of the ceiling and floor is obviously during the cooling off period, and the other point number D also there is a cooling off period, which we said if during the cooling off the midpoint is hit, then the conditions will the flex will not happen. So these are interlinked. And earlier point, it's only the increase in parameters. So if you see A, B, and D, it is A, B, and D. It is only saying if the number of conditions have been increased. That is, the trading member conditions have been introduced in point number A, and the UCC conditions have been increased to 10, and the trades have been increased to 50. And in point number B, it is about concurrent flexing. That if the near month is getting flexed, the other contracts will get flexed, and if underlying is getting flexed, the other contracts will get flexed. And point number C is about telescopic flexing. That is the gravity of flexing. That is the percentage of flex will keep on reducing. So from 5% in first two flex, then it comes to 3% in third and fourth, and then 2% in the fifth and sixth. And the cool off period also increases. So everything is linked. It is, it's not.
So it's not only one section where the cooling off is applicable. The thing is somewhere all around.
So can we show this NSE website on the screen? Because that particular point was very important, that where they can see the LTP ranges. We just want to show so that all the members can benefit. So on the NSE website, use this FAQ on limit price protection. So with all your queries regarding how it is designated, where it is designated, so that you can be informed, you can refer to all these questions as well as the FAQ down here, which specifically talks about the dissemination part. This has a question. Within the FAQ, there is a question which says that how will the trading member know whether it has that clarity? So we just want to ensure that you refer to this particular FAQ.
Sure. I guess that brings end to the questions that members were asking. And probably with that, we hope that all the information which was shared to all of you is clear. Still, as requested by all of us, you can refer to the circulars which we have issued. This session will also be uploaded over YouTube channel, which we have mentioned, NSE's YouTube channel. And there is a playlist called Open House Webinars, under which this session will be uploaded. So within a day, most probably by tomorrow end of day, we'll try to upload it so that you guys can refer and take references of it. Again, as Binoy and Bireshwar requested, please ensure to participate the functionality in the coming Saturday mock, which is 16th of November, so that on 18th, when the system goes live, you are ready with the functionality, all tested and experienced.
Right.
Any last words, Bireshwar, you or Binoy want to make
Yeah,
so that it is comfortable?
So now with this cancellation of orders, you will have to keep a regular tab. What's happening is that once you had put the orders during a day, it was only getting cancelled by the system at the end of the day. So this is the first time that, because of sliding bands, the exchange is cancelling the orders in between the trading day also. So that if the price moves in a certain directions and your order gets cancelled, you will, if you want to take positions again in those, once the price moves down again to those levels, you have to put again those orders again. So to that extent, care has to be taken, and that is the change in the methodology which has come about, and this is an important change. So please try this out thoroughly in the November 16th mock, which will be live on November 18th. Yeah, Vinod.
Yes. I think Bireshwar has covered it all. So, the main highlights, as Bireshwar, the sliding of price band, order cancellation, and the midpoint part, which there, as someone asked whether there will be still order cancellation. So, if the midpoint is hit, there will be no sliding of band, and there will be no order cancellations. And again, in options, there is no order cancellation. That is very important. In the cancellations are only in cash market and the futures. There is no order cancellation options. It is only a temporary floor and ceiling
of the LPP. So temporary floor, ceiling and floor of the LPP. So the entire mechanism that is applicable for LPP still continues. Only the band will be restricted. And the destination also, as we showed you, you can go to the NSE website, refer to the FAQ. There you will have all your questions answered regarding LPP. and broadcasting of the entropy ranges also.
Okay.
And the floor and ceiling is only on the sentimental side. It's not on the opposite side.
Correct. Correct. So on behalf of Team NSC, thank you each and every market participant and member who have joined today. We hope that we were able to, disseminate the information in clear manner. And please, you can write to respective team in case you want further clarity, and our teams will be happy to help you out. Thank you. Thank you very much again for joining today. And thanks, Binoy and Bireshwar, for sharing the information with all the participants.
Thank you, members.
Thank you,
Thanks.
members.